What's up, everyone? Welcome back to ATS Funded. This is your Monday Insight, and today, together, we are breaking down order blocks. We are going to understand what they are, how to identify them properly, and why most traders mark them wrong. So, every trader, of course, wants cleaner entries and strong convictions. And order blocks can give you all of three, but only if you understand the logic, the real logic behind them. So an order block isn't just a random candle off the chart. It's where smart money stepped in with intent. And if you can learn to read the intent of smart money, you can start positioning yourself alongside it. So we're gonna start with what is an order block. So before we start marking zone on the chart, let's define what's really an order block actually is. So an order block is the last candle or a group of candles before a significant displacement in price. It represents the area where the institutional participant accumulated or distributed position before driving the market in just one direction. Think of it this way, like before a big move happens, someone has to build a position. They can't just market buy $1 billion worth of contract without moving prices against themselves. So what they do, they accumulate quietly within a range and then they displace. That quiet accumulation zone, what it is, that's your order block. The reason traders care about those areas, those zones, is very simple. When the price returns to an order block, there's a very high probability that the same participant will defend that area. And they have the position here. Okay, so they have interest in price holding and that gives you an edge. But here's where most traders go wrong. They mark every consolidation candle as an order block without even checking whether the move that follow had any real conviction. That's how you ended up with a full chart full of zone that mean nothing to you. So let's talk about how to filter for the ones that actually really matter. The first thing you need before marking an order block is context. And that context comes from two things, I would say: structure and displacement. You're not just looking for random zone on the chart. You're looking for intent. And intent show up when three things aligns. So the first thing, a break of structure. The price needs to take a significant high or low. That tells you something has changed. The market has committed to a direction. The second step, strong displacement. The move away from the order block should be aggressive. Large body candle, minimal wicks, covering a lot of range in a short time. That's conviction. That's institutional flow. If the money away is low and choppy, it's not displacement, it's indecision. Now we go for the third step, a validation reaction. When price eventually returns to the order block, you want to see how it reacts. A bounce, a weak rejection, a shift in a short-term structure. That reaction is your confirmation that the zone is being defended. Without all three of these elements, you don't have a valid order block. You just have a guess, and guessing is not a strategy. Now let's talk about the candles themselves, because not every candle qualifies as an order block. The most important thing to look is the body of the candle. A large body candle, one where the open and close are very far apart, signals high conviction. It tells you that one side dominated during that period. Buyers or sellers were firmly in control. The smaller candles, especially those with long wicks and tight bodies, that's noise, pure noise. That's indecision. Marking those as order blocks is one of the most common mistakes traders make. If the candle doesn't show clear dominance, skip it. Here's an additional filter that separates good order blocks from great ones. Does a displacement leave behind a fair value gap, FVG, that we covered in the last module? If the price moves so aggressive away from the order block that is create an FVG in the process, that's an added confirmation. Tell you that the move was so one-sided that it left inefficiency behind, and that increased the probability that the order block will hold when price return, of course. So to summarize this section, big body, clear direction, FVG, fair value gap left behind, that's your checklist for candle quality. Once you have verified a valid order block, the next step is knowing exactly where within that zone to plan your entry. And this is where the main threshold comes in. So the main threshold is essentially the 50% level of the order block, the midpoint between the opening gap, the opening price, and the body range of the candle. It's a simple concept that helps you qualify your levels rather than eyeballing them. So why does this matter? Because it gives you two things. The first, a refined entry quality point. Instead of entering at the top of the zone and hoping for the best, you can weigh the price to reach the mean threshold for a precious fill entry. The second, a clear invalidation level. If the price below tap the mean threshold and close behind the order block entirely, the setup is invalid. No emotion, no second guessing. The level told you it failed completely. This is what separates traders from who plan and traders who react. Good entries aren't just luck, they are measured, they are planned. Track the opening price, track the body range, identify the mean threshold, and use it as your decision point. Now here's the part that ties everything together. Time frame alignment. You can find the cleanest order block in the world on a 50-minute chart, but if the daily is bearish and you're trying to go long, you're fighting the current. And fighting the current is how traders blow account. The rule is simple. Zoom out before you zoom in. If the higher time frame is bullish, higher highs, higher low, clear uptrend structure, then you're only looking for long entries on the pullback. You wait your intraday charts to realign with the high time frame bias, and you enter when the order block on the lower time frame line up with the direction on the bigger picture. If the higher time frame is bearish, you flip it. Only shorts, only pull back into bearish order blocks. No exceptions. Don't fight the trend just because it's the start of the week. Don't counter trend because you think a reversal is coming. That's the common mistake. Let the structure tell you where the trend has actually changed, and until it does, trade with it. So let's put it all together. When everything aligns, a high probability order block looks like this. Let's put it into steps. Step 1. Liquidity gets swept. So price takes out a key high or low, triggering stops and trapping traders on the wrong side. The step 2, a strong displacement follow. The market reverse aggressively, leaving behind large body candles and potentially a fair value gap. The step 3, I would say, is a clean order block form. So you can clearly identify the last candle before the displacement. The body is large, the intent is clear. Step 4, when the price returns to the order block, it retraces into the zone, ideally reaching the mean threshold. And going into the step 5, the continuation of course, is when the price reacts from the zone and moves in the direction of the original displacement. That's, I would say, is the sequence. Liquidity swept, displacement, clean order block, retrace, continuation. When you see all 5 steps, you have a setup worth taking with conviction. So order blocks aren't complicated, but they require discipline. You need structure, displacement, candle quality, a measured entry, and a higher time frame alignment. Skip any of those and you're just drawing boxes on chart. The better the plan, the less you guess, and that's what we want to see from our traders at ATS Funded. A clear edge executed with discipline. If you find this useful, check your email. We send a more detailed written breakdown of everything we cover today. And make sure you subscribe so you don't miss the next model. When you're ready to prove your executions, stop risking your personal capital and get funded with ATS Funded. The link is in the description, and see you in the next one. It was a pleasure.